All right, welcome back to the Halftime Report. Let's welcome in our special guest today, Jeffrey Gundlach. He is the co-founder, the CEO of DoubleLine. This is an exclusive interview. It's good to see you on the East Coast on the heels of the Sohn Conference.
Yeah, you know, I was hoping for nice weather.
Well, you brought it.
Yeah, it's pretty nice.
That's for sure, a little LA style out here.
Yeah,
so
even better.
I want to talk to you about Sohn, obviously, but given what's happening in the market today, let's begin there, okay?
Yeah.
Dow's down about 400 points.
Yeah, again.
It was down yesterday.
Yeah, and it rebounded.
And it's all really about trade, escalation, more tariffs coming on Friday. At least that's what the administration is saying. How do you see this whole thing playing out? Let's just start there.
Well, you mean the trade talks
Yeah.
and everything? I think that you've got an irresistible force meeting an immovable object, where both the Premier of China and the President of the United States want to come across that they prevailed and didn't give in, which means to me that I think we're going to keep seeing more tension. And I think that the 25% tariff bump is better than 50% chance.
You do?
Yeah.
What are the markets going to do if we get to Friday and we do increase the tariffs?
Well, it's already happening, I think. The market obviously doesn't want increased tariffs. So it's been kind of reacting to that. But we have to remember that the market hasn't gone anywhere in 15 months. I mean, people keep acting like this is some sort of a locomotive that's chugging along. But the New York Stock Exchange Composite Index, which to me is the most important one because it's the biggest, it peaked in January of 2018, and then it couldn't quite make it back to that peak in October, and now it couldn't quite get back to the October level, and now it's rolling over again. So, you know, you think about where we are now versus October, and just about everything is about where it was or lower. So I think this has been a process of trying to digest, you know, Fed policy pivots, which have created a lot of volatility, and then the fact that the global economy has slowed down in a very major way since the really peak period of late 17, early 18. So I think that's what's going on. One of the things that I'm looking at, and I put this up on the screen at the Ira Sohn fundraiser yesterday, was the one most concerning indicator is there's something called data change indicator by Citibank. And what they do is they just take the whole basket of economic data and they compare what's coming out now to their 12-month moving averages. And that had been at a very, very good level, both for the United States and globally, into the first part of 2018. And for both the global index and the US index, they've absolutely cratered nonstop. And the reason I bring that indicator up, because first of all, it's sending a signal, but beyond that, it's incredibly highly correlated with US GDP, the US data change index. In fact, it leads it, actually. And the divergence between GDP year over year and this indicator year over year, we haven't seen a divergence like this since 05 or 06. So a few months ago, I was saying that there are absolutely no indicators of recession on the horizon. And now we have some that don't suggest imminent problems, but they do suggest that it's not a lock at all, like it used to look like, that we're going to get to the presidential election without economic weakness and concern. And I think that that's pretty important, and I think that's why the market is struggling.
Okay. Let me play devil's advocate with you, okay? We had this big comeback in the market from December. Earnings are better than expected. China is better than expected. They've been stimulating the heck out of things there, and it appears to be working, at least on the surface.
Yes.
Europe isn't as bad as it was. I understand the German numbers were still weak. Earnings here were not of a recession variety. Granted, they were weaker, and they jumped over a very low bar. Mm-hmm. You've got growth here. You have no inflation. I hear the word Goldilocks being tossed around,
with all
Jeffrey.
that, the market hasn't gone up in 15 months. So that's, I think whenever you can tick off things that are backward looking and you tick them off as being favorable, that's priced in. Things that are known are priced in.
Better earnings aren't priced in.
Well, that's why we're back towards where we were in October, I think, is that rebound has to do with earnings being a little bit better, the economy improving in recent weeks until, I think, most recently. You know, and obviously the Powell pivot was a really big deal for the market. And I think that it was the Powell disaster in December that caused the trapdoor market into December 26th. And the pivot was just so violent that basically got largely reversed. So I think that's what's going on.
So why should we go against the pivot now? If it's as powerful as you say, look, we just had a couple of down days in the market, okay? We're down 400 today on the Dow.
Yeah, it's no
Feels
big deal.
bad. Yesterday we had a nice comeback. The overall environment of which you say happened in December still exists. The Fed pivoted.
Yeah.
There was a great pivot, and then they did a double down.
Yes. And there's all in terms of market supporting rhetoric as they can possibly be, except for one thing. I guess they could take away that 2020 hike dot that they put in there, which to me was almost an embarrassment. I mean, you put in the 2020 hike, you have no idea. Look, we went from December to March with a complete different policy narrative. So how can you, with a straight face, talk about 2020 when you changed the dot so radically over just a several-week period? The 2020 dot is there so that the market can say, well, the Fed still thinks that things are okay for the long term, and they're going to be able to sneak in that other rate hike. What if they'd gone to, we're never hiking again, which is precisely what the bond market has been saying for months. Bond market's been saying there won't be an interest rate hike for 5 years. I mean, the 2-year, 3-year, 5-year Treasury yields are exactly the same, which means that there's no chance of a Fed hike based on the bond market pricing for all that time period. So you have to ask yourself, why is that? What is the bond market thinking about? And it must be that we're so late in the cycle, that data's weakening, and that interest rates, amazingly, have been tightened to a level that is causing economic concern. That's what the bond market's saying. And yet, at the same time, while all this happened, the spread between the 5-year U.S. Treasury and the 30-year U.S. Treasury, which hardly anyone pays attention to, but I look at it every day, has been steepening the whole time. When the stock market cratered, the 30-year Treasury bond yield widened to the 5-year. When the stock market roared back, the 30-year Treasury continued to steepen versus the 5-year. Why is that? And I think the reason is that people are starting to realize that and I hate to go back to this issue, but it's so fundamental, that the deficit and the national debt are totally out of control. Last year, 2018, the national debt, forget about the deficit, which isn't really the amount of true borrowing, the national debt increased by over 6% of GDP in 2018. Nominal GDP rose by 5.1. What that means, Judge, is that if we hadn't increased the national debt at all in 2018, GDP nominally would have been negative. And in fact, that's the truth for the last 3 years and the last 5 years, that the national debt growth is responsible for all of the growth in U.S. GDP. So if we're growing debt so much during a 5% nominal GDP period, and you ticked off some economic facts that are reasonably reassuring, what's going to happen when we turn down? And this is the focus that I've been thinking about, the thing that I've been focusing on for a long time. I mean, in the next recession, what's going to happen to the amount of debt, and is the Fed going to allow interest rates to rise at the long end, which is what's going to happen unless they go and emulate the ECB and the JGB. And that kind of, I'm getting a little bit ahead, but that's kind of what was underneath my recommendation at Sohn.
It's not only the national debt that seems to be concerning to some. There's an article today that some on the Fed are worried about the high levels of corporate debt. Chamath Palihapitiya of Social Capital. I visited with him out in San Francisco earlier this week. Yes. You guys have had your thing on Facebook in the past, but that notwithstanding.
I'm not aware of that, but okay. I don't. Oh, he's a Facebook guy.
Yeah.
Oh, I see. Well, so, it's, Facebook is well off its highs.
That notwithstanding, the issue of high levels of corporate debt.
Absolutely. That's been something I've been talking about as well. The corporate bond market was not really a problem in the Great Recession. It got dragged down due to all the economic mess that we were in. But the setup of the corporate bond market is so much worse today than it was in 2006. First of all, it's about triple the size. The triple B market is bigger than the junk bond market. And there was this report by Morgan Stanley Research, which really is worth taking a look at, that says that if you use leverage ratios alone, and there's other variables that rating agencies use, but it seems to me leverage ratio is a really important one when it comes to creditworthiness. If you use leverage ratios alone, fully 45%, not just of the triple Bs, of the entire investment grade corporate bond market, most of them are probably triple Bs, but some of the even higher rated ones would be junk right now. Right now. Think about that. You've got about an $8 trillion corporate bond market, and that means that the amount of downgrades into junk from investment grade, if those statistics stay unchanged, would be bigger than the amount of downgrades in the subprime market.
So what's the spark then?
It's
if
a recession.
It's so concerning, what's the spark? That's it, a recession.
Yes, a downturn. The economy is in such bad shape to withstand a downturn. Again, the national debt is exploding while we're having some of the best GDP year over year that we've had in recent years, right? So the economy is not in any kind of condition for the government to come to the rescue other than really wickedly extraordinary policies a la the ECB and the BOJ.
He also said that the likelihood of a recession has been pushed out because, in his words, the Fed didn't have the intestinal fortitude, those were the words that he used, to actually raise interest rates, even though the economy may support higher interest rates, and thus you're going to just continue to go on.
He's onto something there. The concept of lack of intestinal fortitude, I think, characterizes our era. I mean, is Congress really going to have the stones to do contempt against Barr? I mean, they're supposed to, right? I mean, if you don't respond to subpoena, they're supposed to toss you in. Are they ever really going to do anything other than slap Facebook on the wrist for all the stuff they're doing that people know is really, at best, painting outside the lines? Is that ever going to happen? Is Congress ever going to, do its job? Is the Supreme Court ever going to do its job and stop upholding whatever comes through? I mean, I think there's just lack of intestinal fortitude all over the place. Are the rating agencies ever going to downgrade these companies that should be junk right now, per the Morgan Stanley research report? There just seems to be a lot of that out there, and the Fed seems to be kind of in sync with that social mood. I mean, Powell, he was so pragmatic, supposedly, and disciplined, and really thoughtful. And it comes out, and in December, he actually acts that way. He acted disciplined, his own man, thoughtful. And what happens? The market goes berserk, right? And what does he do? Oh, well, forget it. I'm patient. Completely changes. Just throws in the towel. I think there's just a lot of that going on. So I agree with that. It's just sort of in the air.
Let's do this. Let's take a quick break.
All right.
We'll come back. We'll talk specifically about Jeffrey Gundlach's big idea from the Sohn Conference as well. He's been maintaining that we're still in a bear market for stocks. We'll get his answer to that question. Does he still think that? Next. Welcome back. We're still live and exclusive with DoubleLine's Jeffrey Gundlach. Let's go right to that question I left before the break.
Yeah.
You don't really think we're still in a bear market?
Of course we are. The New York Stock Exchange Composite Index fell over 20%, has failed to return to its high. So definitionally, you're in a bear market until you take out that high. The classic Dow theory is still firmly bear market. The transports have not put in a new high. The Dow Jones Industrials haven't even put in another high. And they put in that same bear signal when they both broke simultaneously to new lows. So yeah, I mean, a bear market is a lot. People talk about this 20% thing, and I mean, I'm okay with that if people want to go there in a conversation. But a bear market is really more about cycles and manias, and then things one by one rolling over, and the market getting narrower and narrower. And I think all of that has been happening over about an 18-month time period. So yes, I think that we're in a late cycle, and I think that the market can only be termed, by the way I look at evolution of market prices, as a bear market. It's certainly recovered a lot. Quite frankly, when you think about trade location, which investing is a lot to do about probabilities. Nobody's 100% right. Very few people are even 51% right. I'm usually about 70% right, which sounds like a lot, but there's a lot of wrong if you're 30% wrong. I mean, I've been in this business over 35 years, so I've been wrong like 11 years. Thank God they weren't in a row, right? But I've also been right, 24.
You wouldn't be sitting here if it was 11 in a row.
24 years, right? But it's kind of the way things evolve along the way. And to me, the mania this time was Bitcoin. And then we put in that global synchronized top, January 26th of 2018. And now everything's rolling over. And, interest rates are rising. The Fed, it weirdly looks like they, well, frankly, Jay Powell's most recent press conference looked lost to me. Or maybe the right word is scared. Scared to say anything. So we're kind of rudderless now, I think, in terms of the Fed. They just want things to be okay and hold together, and they don't want to say anything or change their rhetoric or scare anybody. But again, I think the economic message is nowhere near as strong as it was. And the first quarter GDP was reported to be pretty good. But what was underneath that was a fluke in the deflator. The deflator was only 0.9. And because it dropped from the level that was significantly higher the quarter before, that shows up as real GDP. But nominal GDP did not increase. It was just the deflator went down. And the reason the deflator went down is it kind of works with a 3-month lag. So one thing about this year that's deceiving is everything in oil, in stocks, junk bonds, it all seems so strong. But that's because of the arbitrary start date of year end. You know, oil hit its low basically right at year end. Stocks hit their low right at year end. So because the deflator works with like a 3-month lag, the first quarter deflator was really depressed because of the year end phenomena. And it's going to rebound because oil has rebounded massively during the first quarter of this year. And so the deflator is almost certain to go up in the second quarter, which means you can almost see it a little bit in GDP now, which I think is at 1.7, which is bad. But my guess is it gets revised lower because of the deflator. So I don't really see the case, based upon the evolution of the market over the past 15 months, for people to be talking in the terms that they do, focused on this anomalous period, which is year to date, which is based upon this fluke of everything bottoming out exactly on December 26th.
Sure, but the pivot was no fluke. And what if I say, dare I say, maybe this is going to be the 12th time out of this great career of yours that you're going to be wrong, that the pivot was that strong. The economic story isn't going to be as bad, and you're going to get a trade deal, and the market's going to go higher, and the things that you say are the tell of why we're in a bear market are going to turn bullish, and we're going to get back to the bullish ways. Someone watching is probably saying that.
Since I just did Sohn, and I often quote people at Sohn, I'll quote the president. We'll see. We'll see about that. I think a lot of that's priced in. Last year at the Barron's Roundtable, 2018, January 2018, I said the market will go up double digits into the summer, maybe even 15%. It didn't quite make 15, it made double digits, but it will end the year with a minus sign. In late September and the very early part of October, DoubleLine's call center was ringing off the hook. How can he say that? Does he really actually still believe that the stock market's going to close with a negative sign? And I told my guys and girls, gals, to say yes. That's what I think. And sure enough, it ended not just with a negative sign, with a pretty big number next to that negative sign. So, you know, things change. And I'm going to keep hearkening back to the fact that the stock market has gone nowhere in the United States in 15 months, and it's down in many parts of the world. So I don't know, I'm going to flip the question. If anybody wants to say, how can I say it's a bear market? How can you say it's a bull market? I mean, it's been a good year to date. Yes, I agree. But to characterize the last 15 months as a bull market is just wrong.
We'll see where it goes from here.
We'll see.
So one place you do see us going from here is a much greater level of volatility with interest rates. Okay?
Everywhere, but interest rates is what I focused on.
Okay, and that plays into the trade that you laid out yesterday at Sohn. In layman's terms, tell our viewers right now why this is the trade to do now and how they're going to make money in it, because that's the question.
Right. Well, I believe that that interest rates have been, at the long end in the United States, have been unusually stable for a while, even as short rates have gone up 200 basis points, long rates have come down, even as the Fed has done all this pivoting stuff and everything, rates at the long end have been amazingly stable. And because of that, volatility that's priced into options in the options market is at the all-time low in many places, in particular on things like 30-year treasuries. The lowest ever, and not by a little, by a lot. And that's born of backward-looking, hey, volatility's low, it's not going to stay low forever. So the pricing of options on long-term treasury bonds has never been cheaper, ever. And is completely plausible that that volatility could double when people change their mind and it goes back to like its average would be kind of double where it is today. So my idea was, why don't we take advantage of that, given the idea that I don't think rates can really stay here for a year at the long end, that I think the Fed is all over the place, that if the economy is strong, as maybe you're trying to argue, that rates might go up at the long end, which has been happening. If the economy is weak, I believe rates will go up at the long end. All things being equal, if the Fed stays out of the way, which is a huge if, right? But if they did, I think people would realize that a $4 trillion deficit is what we're looking at in the next recession, 20% of GDP. Where are you going to float those bonds, right? So I think that interest rates are likely to go up. Now, however, if rates go up, maybe the Fed says, call in the fire trucks, we're going to be ECB and the BOJ, we're going to go to modern monetary theory, which isn't modern, isn't monetary, and isn't much of a theory, but they might implement it. And basically what's underneath for the layman, modern monetary theory, is when you go into recession, you take rates to zero. That's basically what it's about. So maybe the Fed then puts on, throws the gasoline on the fire and puts rates down at zero. So either way, I think you're going to get a move in interest rate. And you're betting that rates will move by, let's just call a round number, 50 basis points somewhere along the way. If that happens in either direction, so either the natural forces take rates up or the Fed comes to the rescue, you make 70% if it happens 1 year from now. Also, if volatility just normalizes, so volatility just goes back to its average, who knows what reason? Maybe people get nervous because Bernie Sanders chooses to run as an independent or something, who knows? If that happens, you make a 70% profit if the volatility goes back to normal in 6 months. So rates, all you need is either volatility go up over the next 6 months, you make 70%, or you need rates to move in a 1 year time frame about 45 basis points, and you make 40% or 50% or so. And what I think is actually going to happen is you'll make money on both sides. I think what will happen is when the economy weakens sometime over the next 12 months, people will start freaking out about the deficit, long rates will go up, but then if the Fed comes to the rescue, they might take it down to zero and you might make money on the calls. And all this could happen in the next year. And if it doesn't, I think you just make money on the volatility side. So what I'm betting on is that everything that you were playing devil's advocate about, everything's copacetic, everything's stable, everything's great. And I'll even add to that, and the stock market is also stable. It hasn't gone anywhere in 15 months, okay? All of that is the past. And you may not remember this, but I was I did a remote with you. It was about July of 2017. And you said, what's your highest conviction idea? And at the time, the VIX was all the rage because it was trading forever below 10. And the VIX on the stock market, the volatility index, was at 9.81 as I was talking to you. And you said, what's your highest conviction idea? And I said, volatility is going up. Volatility is going to go up, and I'm positive you're going to be able to get, buy the VIX, but sell it at 15 volatility instead of 9.81. What's funny about that is what so often happens when I go on your show is people spend the next couple hours on the network talking about what an idiot I am and how wrong I am and that I'm never right, which is not quite true.
That's not exactly true either.
Well, I'm being facetious. I'm being hyperbolic. But anyway, the point is that somebody went on that day that I said my greatest idea was long vol and said Gundlach is an idiot. He doesn't understand that the VIX has fundamentally changed and it will never go above 15 again. What was funny about that, it was at 15 the next day. It was at 15 the next day and ended up going up to, I don't remember how high, but it was 30 or 35 or something like that. I feel that this is a moment that is somewhat similar to that moment. The shorts on the VIX are at an all-time record high. One of the reasons for that is it's such a high carry thing. If you're having trouble performing in your hedge fund, shorting the VIX, if nothing happens, is a massive moneymaker. There are months where it carries at 5%, not annualized, 5% for the month. So think about how many holes that fills up, right? So I think that we're in that same type of a setup, and that volatility is likely to go up a lot, particularly as we move towards January and the election season and everything, which I have predicted that there is a pretty good chance that we get more than 2 candidates who are running, who are funded. I'm not talking about, these fringe people that put their name on the ballot, not really on anywhere.
You alluded to it a moment ago.
Bernie Sanders can raise money. He's proven that.
Barry Sanders is pretty good, too.
Barry Sanders can run really well. Guy retired right when he was about to set the record.
It's true.
It was pretty strange, but he was a great runner, really fun to watch.
So look,
Bernie Sanders can raise money. right? So if he doesn't get the nomination, it looks he probably has a ceiling in the Democratic Party, particularly because he's getting chipped away at by all of these what I call the 1%ers, all these people. They probably are in the 1% economically, but they're polling at 1%. There's like a dozen of them that can't get out of their own way in terms of the polling. They all have the same message.
You said you'd short all of them yesterday.
No, short the 1%ers. I was misquoted. The slide was their 1%ers are these 12, and just go to Real Clear Politics and look up the polling. It's the 12 that are asterisk. There's some that are at 0. Can you imagine running for president? You have 0, and you're still out there on the trail.
It's still early.
Yeah, it's real early. But I mean, if your message is what Bernie said, you're probably not going to get very far when Bernie's still there saying it. But Bernie can raise money, and so can, the more traditional machine, and maybe so can, somebody else who takes up the mantle against Trump, which is still possible. In the Democratic Party, there are people talking within the Republican Party, of challenging Trump. So I'm skeptical that they would really get there, but I do believe it's quite possible that we have that kind of 3 funded candidates thing, almost like 1992, which gets things a little bit different from the historical pattern and could cause a lot of uncertainty.
I mean, we recall, obviously, where you said that you thought Trump was going to win.
Yes,
the last election.
I said that before the primary started.
So what's going to happen in 20? Does he win re-election?
I don't know yet.
Does he face Biden?
It's it was foolhardy for me to declare Trump would be the winner as early as the first week of January.
No, but you did it so well. Let's do it again.
Yeah, but we're not even close to January yet. I mean, we're so far out that I'll have the courage to make a prediction come January. But right now, there's too much time for economic realities to change. I think that if the economy actually printed a negative number, Trump would clearly try to blame it on Jerome Powell. That's what his gambit is here.
Don't you? The whole thing is
that whole thing about raise rates, cut rates 100 basis points and start QE. That's insane. Mike Pence got up and said, and I know he's just doing this because Trump wants him to, but he said our economy is roaring. This is on Friday after the jobs number, roaring, and then the next breath, and we should cut rates 100 basis points and start QE.
He did that with our Eamon Javers on this network.
It's just unbelievable. I mean, which is it, man? Is the economy roaring, or do we need hyper stimulus? I guess they just want both until you can go into a modern monetary theory thing. But there's a lot of economic time between now and January, and things can definitely change. Think of how radically things changed in the fourth quarter. So here's what I'm going to say. If the economy does print a negative sign and Trump can't get away with, which I don't think he will, blaming it on Jerome Powell, he can't brag about the economy anymore. That's what he's about, is bragging about the economy. He keeps talking about how the jobs have never been created so much, like ever in history, except for one little fact. If you take the number of months that Trump's been in office and take the average non-farm payrolls and compare it to the same number of months at the end of the Obama presidency, there were more under Obama. Not by a lot, but there were more. I mean, it's just unbelievable, the twilight zone that we're sort of living in, where people just say things and it gets repeated. I think it's probably we're numbed to that because of social media.
You've said a lot, and it's going to get repeated.
I'm sure.
But we appreciate it very much. As always, Jeffrey Gundlach, DoubleLine. Great to spend time with you. That does it for us. The Exchange with Kelly Evans begins right now.